We need to know two very important things. These things are the swing points and the trend. A simple way to notice the swing points is to draw with arrows the direction the market is going. For example, on the left of this market, we start from a low, then from this low, we get an upwards movement setting a high. From this high, we pull back down into another low. Now usually, the upcoming lows end up on a demand that was made from the previous lows, the market often bouncing to the upside from a demand into breaking above the last high. When the last high breaks to the upside, that's a confirmation of a new high, and because the new high is higher than the previous one, we call it a higher high. But that's not the only thing it confirms. Now we also know that this new low is higher than the previous low, a so-called higher low. Then from the higher high, we got a pull to the downside. The key part is that it broke below the previous higher low. So initially, when we have a combination of a higher low with a higher high, that signals that the market is following an uptrend. But the moment the market breaks the last low, that's when the trend changes and reverses into a downtrend, since now we have the first lower low swing point. And now in the last candles that we can see, it's starting to push to the upside. Now the question is, where do we expect this movement to end? Should it end above the last high or below the last high? Well, the moment we got the first lower low in an uptrend, that's when, based on the market structure theory, there is a high probability we reversed into a downtrend. The swing points of a downtrend are formed with a combination of lower lows with lower highs, and we already have the lower low, so there are higher chances we see a lower high coming up next rather than a higher high. Now, opposite to the demand zone, during downtrends, the market bounced to the downside from a supply, which is the last candle that closed bullish on the swing high. That's also right before the market started to turn bearish, and these supply zones can give great setups for sell positions. On the simplest way of doing it, we just use this supply and place the sell entry right at the bottom of the supply, which is basically the exact moment the market starts hitting that zone. The stop loss is usually placed above the supply, which should also coincide being above the last swing high that formed the demand. And the take profit should be below one of the previous lows to get a minimum of a 1-to-2 risk-reward ratio, preferably 2.5. And since this position basically already opened, because the market is sitting right now on the supply, we just need to wait for now. We quickly get a bearish reaction down from the supply, the theory respecting, and this goes straight down into the take profit. After you win a setup, what I suggest is just leaving the charts for some time, but for the sake of education in this video, we will analyze the price action that the market has formed lately, just like we would if we would enter into another chart. So what happened is that we kept a downtrending price action of lower highs combined with lower lows. So if we apply what we just did, step by step, we identify a supply on a lower high. Now the question is, which lower high? Because we have one right here, with a supply zone attached to it. But we also have a lower high here that has another supply. In these types of situations, it's better to take the highest supply available. Or you could also think of the next supply that's below the one from the highest level. So if we had this supply that we already have traded, we look at the next one. That's on the next lower high. This is the next lower high. So we use the supply that's attached to this next lower high. Now we can sell short this supply just like we've done on the last setup, which was the simplest way of doing it. Or we can use a concept named time frame alignment. We can use this to scalp positions or increase the quality of a setup. And by increasing the quality, we mean about increasing the probability as much as we can to get a winning setup. That's done the moment the market pulls back and gets really close to the supply. When it's getting close, what we do is to switch into a lower time frame. For example, in this case, if we're on the 15 minutes chart, we'll jump into the 5 minutes. Here we have the same market and the same price, just shared across more candles. If the structure of the candles look different, then we must do a quick analysis of the recent price action. In this case, we had that downtrend from the 15 minutes chart that formed a swing low. From this low, the market is pulling to the upside with what they look to be very bullish candles. Then a small pullback to the downside happened. The most important part is that this upside movement broke above the last high of this time frame, so it went from a high into a higher high. And from the swing low, here, the next time the market moved to the downside, was here, where the next low ended above the last one. So this sets a higher low. But not to be confused with the swing points from the 15 minutes time frame, because those are external swing points, and here these are internal swing points. So if we see the market following an uptrend in this 5 minutes chart, that does not mean the market is in an uptrend on the 15 minutes time frame. In fact, this 5 minutes uptrend can be only a pullback to the upside of the higher time frame. And we actually do have an uptrend on this 5 minutes chart. We can see how we had higher highs on swing points, but on the swing points of this time frame, and not from the 15 minutes. And on uptrends, the upcoming low must end above the last low. And the level that low often ends up is on a demand zone, which is found on the recent higher low. This being the internal demand from the 5 minutes time frame. When you have two zones, a supply from the higher time frame but also a demand from a low time frame, most of the times the structure from the higher time frame will be more valid. In this case, we're talking about the supply, which was formed from the 15 minutes chart. We can still place a buy position from this demand, but since the supply is higher quality, we should exit before the market might hit the supply. But if there is only one position that we take, the sell from the supply has a higher probability of respecting. With the stop loss above the supply, take profit below the recent low. It should target around a 2.5 ratio or slightly higher, but wouldn't target more than that. The demand filled and it's now bouncing to the upside. The bounce went into filling the supply with a wick, and the exact same candle that opened these position also closed the position on the take profit. Now this was a really quick setup. We won't get many of these ones. But now after we're done, we can start to analyze on what happened and what caused this. So from hitting the demand, the market pushed to the upside, which broke above the last higher high, creating a new higher high on this 5 minutes time frame. And from this higher high, the market pulled down and broke below the previous low. So this is again a trend change since we now have the first lower low. A trend change from an uptrend into a downtrend. On downtrends after a lower low, we should be expecting a potential lower high. That means we should be looking for the market to pull back to the upside. However, this pullback should not be able to break above the last high, but instead it needs to end below it. And from there we should see a bearish continuation. Basically a push to the downside which breaks below the last lower low, forming a new lower low. So if we expect the next high to be lower than the previous one, that high usually ends up on a supply zone, and we look to identify that supply that's on the last high, which should be around this level, which is the last bullish candle before the market reversed down. And this is an internal supply. A supply on the lower time frame, on the 5 minutes chart, and we try again with a sell setup on the new supply, with the stop loss above it, and take profit below the previous internal low. In this case it brings a higher ratio, but it's still the first target it can take, being right below the first lower low. The pullback begins with bullish pressure increasing, eventually hits the supply which opens the sell position, and we see how the exact next candle is closing bearish, and the market looks to be rejecting back down after hitting the supply. It's holding a bearish formation of lower highs, nothing to worry as long as the market keeps holding this price action. And a few minutes later, it hits on the take profit target. Let's try fresh on another chart, still on the 15 minutes time frame. And we start by analyzing the swing points the market has been forming lately. Initially, we had a push to the upside, which formed a high. Then it pulled back down, which formed a low. And from that low, we continued higher into breaking above the last high. So having a new high above the last one, that's a higher high. Essentially, the market has been following an uptrend, but this uptrend wasn't sustained for longer because as we can see from this higher high, it started to drop back down, breaking below the previous low. So it forms a low that's lower than the last one, being the first lower low swing point. So this is where the trend changed from an uptrend into a downtrend. On downtrends, we have upside pullbacks that end up below the previous highs, being lower highs, and these lower highs end up on a supply that was taken from the previous high, and when we have a lower low and then a lower high, the next swing point would be a lower low, basically a rejection down from this supply into breaking the past low, so it can validate a lower low. And since this supply has already been used, we look for the next one. And if you remember from the last market, the next supply is found on the next lower high, which is exactly the level where the market rejected from the first supply. And this becomes the new supply zone, with the market currently sitting right at this level. So if we switch on a lower time frame, from the 15 minutes to the 5 minutes, we see the price action the market had when it was approaching the supply from the 15 minutes time frame. The market was following an uptrend on this 5 minutes time frame, which is what led to the supply being filled. Now we know that an uptrend is basically a formation of higher lows combined with higher highs, and it's exactly what we're seeing here. And on the last price action, basically right when the market hit into the higher supply, that's when it validated a higher high internally. Now after a higher high, we expect a higher low, and from a higher low, a higher high is expected. This, of course, in case the uptrend holds, but it shouldn't hold for long since we're in a high time frame supply, and eventually the market has a quite high probability of reversing back down, which is what happened right now. If you look closely, the last pull to the downside managed to break below the last higher low, this turning it into a lower low, and the first lower low, while the market was in an uptrend, reverses the uptrend into a downtrend. A downtrend has swing points of lower lows, which we already have here, the first one, combined with lower highs, which is what should be coming up next. The lower high usually ends up on a supply, so we identify the supply on the last high, and we look to position a sell setup on this supply, with the entry on the bottom of the supply, stop loss above it, and take profit below the previous internal low, since we should be expecting another lower low, because that's what happens on downtrends. The market is pulling back to the upside. It eventually hits into the supply, opening the sell position, and we quickly see how it reacts bearish right from hitting the supply. And minutes later, it closes as a winning setup. So this is how we can get these simple and great setups, by mainly understanding the swing points the market is forming and the trend the market is following. There were a few more concepts like time frame alignment. I have all of these on the program that I linked in the description. We have there concepts that assist this strategy in increasing the probability. Because remember, in trading nothing is certain. Trading is all about probabilities.